Hello, this is Wilfred Hahn, Chairman and Co-Chief Investment Officer of Hahn Investment Stewards. I'd like to bring you the monthly update for May. Very interesting month, actually a continuation of some of the volatilities of the previous month. Let's just go to the markets. A brief overview. Equity markets did not do so well this last month. The previous month they did do well. We're seeing some real rotations here between the different asset classes. Bonds, on the other hand, had a little bit of a recovery in May, having had a bad month in April. Those of you who will have tuned in on the previous monthly update will already have been apprised of some of the volatilities in the various asset classes. So we've been having some revolving between the two asset classes here the last couple of months. But important to look at the longer term results, and so far year to date, as most will recall, we started off the year very, very strong. Financial markets pretty much everywhere, all asset classes did well. And year to date, still showing very strong positive numbers for stocks and bonds in Canada. Now, Canadians who do have foreign content in their portfolios, particularly our portfolios, all of our core portfolios and completion strategy portfolios, have a fair component of international assets. They will have benefited fairly strongly because of the weak Canadian dollar so far this year. It's oscillated also. This is part of the story, the reality that we're seeing here right now. Last couple of months, and we think it will continue for a while. This volatility should be expected to be a little bit higher. Doesn't say anything about long-term returns, but it just says that the results over the short term, as I'll show you here in just a second, are expected to be a little more volatile, and they certainly have been so far. I had mentioned the Canadian dollar having added, its weakness having added a lot of translation gains to foreign content owned by Canadians. There again, volatility, the Canadian dollar was very, very weak, and then we had a fairly strong rally against the US dollar in March-April period, and then again it's been weak here recently again, adding to the performance overall. So you can see diversified portfolios are very important because there are a lot of contrasting trends underneath. Really not much more to be said about market performances here recently. Pretty much the same kind of pattern as in recent months, and we think that will continue. Well, let's turn to actual results for portfolios. We always like to stress that short-term numbers aren't very significant whatsoever. We can surely explain them, but they really have very little relevance to long-term results. And I want to go in on that topic just a little bit, but first I'll just mention the performances on our portfolios generally, and here again we show just our core strategies, and all of them were positive for the month of May. As clients will already know, April was a weak month for portfolios overall. Virtually everything turned down, as already mentioned in the market overview, and again started out very, very strong this year, and we were careful to mention to everybody that that certainly wasn't sustainable. And historical patterns always suggest that you get a bit of a correction. So year to date, all the portfolios are doing really well, still very good returns, especially if you were to annualize them, which we don't. And all of them are outperforming their benchmarks. So that's what we like to look at, is how we're doing in the intermediate term, how our performance lining with our long-term record. And so good results here this May, and back to the positives, and as mentioned, we did have some negative cyclicality in the previous months. Now I want to explain some of that for the benefit of many new clients, and perhaps it'll be useful for some of our clients that have been with us a long, long time. One of the aspects of investing in financial markets, longer term dated assets as they're called, long-term investing, is an implicit deal is made to reach for higher returns longer term. And to compare that possibility against, say, a cash deposit. If you were to put a cash deposit into a bank, you'll get a fixed rate, but it'll be very, very low. So you can sleep at night, perhaps, but you might not be happy with that very low rate. Certainly these last few years, interest rates have been very, very low. Unacceptable, really, to many investors. And certainly one couldn't really reliably build a retirement nest egg with such low rates. One really needs to look for longer term solutions and longer term gains. So back to my point is to reach for those higher returns that are possible in financial markets, one needs then to accept some volatility and in the longer run get those higher returns versus what could have been a short-term cash deposit. But again, the trade-off is one needs to be comfortable with shorter-term volatility. And I want to just take a couple of moments to explain and just show you a bit about historical record as to how that plays out, and hopefully that'll give investors a bit more insight as to how financial markets work, and perhaps you'll be a little more comfortable about that. So the objective here is long-term investing, and why it's to achieve this higher return, and how we try to do it is through an unemotional risk management approach, and try to achieve low drawdowns. Markets go up and down, and there are periods of extended declines, and it's very important that when those decline periods happen, that we truncate those losses so that we lose less and can do better also in the better environments cumulatively. So, as I mentioned, need to accept a little bit more volatility, but there's different kinds of volatility, and I would like to explain that here now. I call it 3 tiers of portfolio volatility. Number one is what we call short-term noise, like for example a monthly return on our portfolio or a market asset or so forth. Really irrelevant. It doesn't tell you much. In fact, 3 months, 6 months, perhaps sometimes even a year, those kinds of fluctuations can be very, very meaningless in the context of a longer-term perspective and portfolio theory overall. Number two is the kind of volatility that is associated with what we would call cyclical risk. There's economic cycles, business cycles. Different sectors do better at different periods of those cycles and so forth. So that's a form of volatility that can be meaningful, and we certainly try to take advantage of that. And then there's long-term volatility. That's these big, epic, secular swings, and it's very important that we do our job as an investment manager in those periods of times. Think about the global crisis, financial crisis, which started in 2008, 2009. Long lead up to it, investment managers really needed to make sure that they could see that risks were high during that period of time to be able to better insulate client portfolios on the downside when that happened. So that's our job, and we're certainly going to try to continue to do that. We're not perspicacious, we're not prophets, but we do our very best to do that. So I got a couple of slides here. I'll try to be very quick, and again, just give you a perspective on how this volatility aspect needs to be dealt with. So first, to the short-term noise aspect. What I'm showing you on this slide here is real results on a monthly basis for 3 of our core portfolios. We're showing you the actual return, pre-fees and costs, and then also the benchmark. What a benchmark is a compilation of the strategic composition of that portfolio. In other words, the asset types and investments we're allowed to have with a benchmark. And so it'll tell you the return for that portfolio had we done nothing other than just build that portfolio. The actual result will then include the active strategies that we've put into those portfolios, hopefully to even better the returns on that benchmark column that you'll see there. And 2 things here, at least one thing here I want to point out to you, is if you look at that column, let's say for the moderate core, which is those middle 2 columns, you'll see month to month, these numbers go all over the place, really, don't they? And we would just say it's not that meaningful if you just look at a couple of those short-term months. Now recently, April, we did have a negative month in the moderate core portfolio, as we did virtually for all portfolios. In fact, anybody who would have had a portfolio, a balanced portfolio, anywhere, anytime at that time, would have seen some negative results. But negative numbers do come up from time to time, and they're really not all that indicative of a longer-term trend whatsoever. What we're trying to do, as those 2 highlighted areas show you, is we'd at least like not to lose more, and in fact like to lose less in those bad environments. And of course, if you can do that cumulatively and also outperform in the up markets, that's going to add progressively to good long-term performance. So short-term noise, really shouldn't pay attention to it. We don't. It doesn't give us any valid insights into longer-term strategies and trends and so forth. So next, I'd like to go to that middle tier, intermediate term volatility. And quickly, this is relevant to those of you who have new investments, new portfolios. And that's the one risk that's, or I should say volatility, that's very, very, very difficult to forecast. I don't know anybody, certainly haven't come across anybody who's got short-term forecasting ability. It's really randomness in a sense. And so when one opens a new portfolio and implements it, one really doesn't know where we are on the volatility curves. And we show you a little illustration here of how markets might have a regular oscillation volatility, let's say, around a longer term trend. And sometimes you're above that, sometimes you're below that. When you implement a new portfolio, you may be investing at a point in time where the markets are a little higher than that long-term trend. So that's kind of unfortunate, but really it's a throw of the dice. It's like throwing a rock, skipping stone into a lake. You have to make sure you hit it on the right wave, or else you're not going to get any skips on those rocks. So kind of similar. So not significant if one sticks with the portfolio longer term. Ultimately, it works its way out, and the results start tracking the longer term trend. So I wouldn't pay too much attention. I wish human beings could be that precise in their forecasting, so we could always make sure that when we implement any particular investment, that it is at precisely the low and not the high. But that's just life, and that's just the way it is. So as mentioned, it's a tragedy that despite the availability of such good returns in financial markets, particularly over long periods of time, that the average investor does so poorly, as I mentioned, even underperforming a bank deposit. So what to do? It's all about managing emotions and disciplines longer term. It's our job to try to manage these larger secular type trend changes when these crisis periods come. Everything is difficult to forecast, but we try to look at the risks and so forth, and try to adjust portfolios through those kinds of environments. So in conclusion, volatility is part of the game. If you wish to have returns higher than the bank deposit, and that's a personal decision, one has to accept some volatility in markets. It's three different kinds. The short term is absolutely meaningless. Monthly to quarterly. The intermediate term, which is more cyclically oriented, maybe 3 months to 2 years to say, also very difficult to forecast, and they certainly do contribute to long-term trends, but not necessarily reliably. And finally, the really big volatility are these big boom-bust cycles, and that's what we need to pay attention to, and that's our job. So thank you for joining us. I hope those explanations were helpful. Again, we always like to remind everyone that we have lots of materials, resource materials available on our website. Please access our website at honinvest.com. Thank you for joining us. We'll see you next month. Goodbye.